Okay, so now it seems that we are live.
Awesome. Yeah,
Cool.
excited to be here.
So we have here today Martin, founder and CEO of Mountain Protocol. So the objective of today's uh, streaming is to discuss a little bit like treasury management. How can like CFOs, foundations, treasurers in general like diversify their portfolios? So maybe we can start with an intro from you, Martin. Then I will introduce myself as well, and we go straight to the bone.
Awesome. Sounds good. Cool. I'm originally from Argentina, so you're gonna pick a little bit of the Latin accent in the conversation. From Patagonia, small town, studied engineering. Got my first internship job on building metal pipes for oil and gas companies, and my first salary, like internship salary, I spent it on Bitcoin because of the known inflation problem in Argentina. So got kind of forced into Bitcoin by the economic situation of the country. Um, I have been in finance ever since. I've always stayed as a kind of participant in the crypto economy as a person. But my professional career, I spent it mostly in banks, working with everything from risk, bank failures, launching new products with banks. So know kind of like the banking space pretty well, kind of in and out. And in 2022, started Mountain Protocol with the idea of bringing kind of like the best that we know from banking into crypto, and actually offering what for many people in the US is kind of a given, which is a high yield checking account, offering that same type of experience, which is low risk, yield bearing dollar for everyone in the world, and doing it in the best way possible. And I'm sure we're going to talk about it a little bit later. And the yeah, so been in finance all of my career, mostly on TradFi, and kind of like this is the first crypto company, if we can call it as such. I think we're still very much of a TradFi company in what we do every day, but we do offer a product on crypto. So, and then we can talk about Mountain a little bit afterwards.
Perfect. So from my side, I'm Seb, founder and CEO of Skyline Digital. As some of our audience might know, Skyline Digital, our goal is to build the first non-custodial Web3 bank. Right now, we are offering like a payment solution mainly to like high net worth individuals, foundations, crypto projects, and so on, that allows them to do payment processing like crypto to fiat, fiat to crypto, crypto to crypto. We are also a big ambassadors of Mountain Protocol and USDM. So like we have some of our clients using USDM as a solution to diversify their treasury and have like yield bearing stablecoins. We also provide a lot of OTC support to projects and to high net worth individuals that want to swap Bitcoin to Euro, Bitcoin to USDC. We have like a ton of institutional liquidity in the background supporting our operation. So like we have very efficient ways of working with our to support our clients. So going straight to the point, like I believe that we already mentioned treasury management 2 or 3 times. So maybe it would be great to hear from the man like what is treasury management. I think this is a concept that needs to be really like explained to people. Like we have a lot of CFOs, like treasurers that need to improve their cash flow, optimize like their portfolios. Like how can somebody like jump into this concept easily? It would be great to hear from you.
Yeah, awesome. So when we think about treasury management as a business, you fundraise or collect in some way resources that you're going to be using to execute the purpose of that organization, whether it's a business or it's a foundation, a nonprofit, whatever it is. This entity has raised, or this individual has raised funds, and a treasury management is the activity of the administration of those funds to maximize the value of the purpose of that enterprise, right? So if it's a business, you might raise money from VCs, and that money that you raise from VCs, you want to keep it to maximize the odds that the business that you fundraised for is going to be successful. If you're a foundation, kind of like probably you did a token sale. You kept tokens for yourself as well. So all of those are the funds that you have to maximize the purpose of your foundation. And what I think is kind of like different between treasury management to other participants in the crypto space, kind of like traders or hedge funds. Treasury management as a whole, the targets are a little bit different than for a trader. So if you're a treasury manager, your objective is to do capital preservation as the number one thing, right? So the last thing that you want is for the company to go under because you took too much risk as a treasury manager, right? The treasury management is not or should not be compensated for taking risk, should be compensated for maximizing the lifetime of the funds that are collected. Whereas for a trader, for example, they will fundraise money. Like if you're a traditional trading shop, you will collect funds from private individuals. Those individuals expect you to be taking some sort of risk to do things that are not obvious for them, right? So if you're just buying ETH as a fund or buying USDM, the investors are going to tell you, but I could do that myself. Like, what value are you adding as a trader? What alpha are you harvesting? So treasury management is different in that like there's less alpha harvesting and there's more capital preservation. Outside of that, both inside of that mandate are meant to optimize the types of returns that they can get. But of course, treasury management is going to be a lot more conservative in terms of those returns you will target. And the objective is those returns aim to extend your runway, right? In some way. And also, in many cases, help your ecosystem in some sort of way, right? Or help your cause, right? Like the reason why you started this business or this foundation in some sort of way. And we've been seeing a ton of businesses, and we do it ourselves. We use our treasury to provide liquidity on use cases of USDM that we want to kickstart, right? So we'll be starting a lending pool soon to be announced with a partner. The initial seed capital for that pool will be part of our treasury, right? So we use it as a way to incentivize our mission. Arbitrum right now is doing a big tokenized treasury and yield-bearing asset purchase as part of their STEP program. And the objective is, again, both the typical treasurer, like capital preservation, yield harvesting, but also promoting products that help the Arbitrum ecosystem grow. So yeah. It's a broad spectrum. I think it's different from traders and hedge funds, and more about capital preservation, yield acquisition, and also using your treasury as a means to the end of the business that you started with.
So it's like, from my perspective, and correct me if I'm wrong, like I think the first, when you say capital preservation, like the first level will be obviously to fight inflation, right? Like that should be like the goal number one. It's like, how can we at least keep up with inflation, having like a good treasury management, like either with T-bills or whatever, might be a good way to do it. And just to conclude on this topic, because like you enter slightly like in a slightly like in a topic which is like the part of treasury management versus asset management, and like it would be great if you could like just give like a clear from your understanding, like a clear separation between both, because like some of our listeners might not like be super aware of this.
Yeah, so the asset management business is about paying someone to manage assets that have a specific purpose, and usually you have passive asset management. That would be S&P 500 would be what Warren Buffett would recommend, or you have active asset management. Most of the assets in crypto that we hear about tend to be active asset management. This active asset management, because you're getting compensated, folks will want you to be taking more complex strategies to get better returns. Treasury management, you're investing your own entity assets into a product or into a certain strategies. You will probably use the similar products as the asset managers, right? Like that is not going to be very different. But the objective of that investment is going to be slightly different, and in general, it's going to be a lot more conservative. That's the usual thing that you're going to see. The second one being the risk return is not the only thing that is looked at. There's also how can this grow my cost, which in crypto is very common to use your treasury to do that. So I would say that's the kind of clear-cut separation between two, or at least how I see it.
Perfect. So, like, one thing that it's important, it's like, since the focus today is treasury management, like, I see USDM, which is Mountain's main product today, as capital preservation product, obviously, like a way to fight inflation, try to extend the runway, etc., etc. Can you tell us a little bit more about like how USDM works and how like USDM can be comparable or not with tokenized securities?
Awesome. So, first of all, kind of introduce USDM to the audience. So USDM is a stablecoin, yield-bearing stablecoin issued by Mountain Protocol. We essentially kind of the insight that triggered Mountain Protocol was I worked for two high-yield checking account projects in TradFi, and so in the US specifically. And so those two banks collect a huge number of deposits from both individuals and businesses looking for an easy way to park their dollars in a way that doesn't generate a trade-off that most traditional treasury management opportunities offer. So this is a account that is you deposit dollars, you get yield, and then you can take them out whenever you want. So it's like a fully liquid treasury management product. If we take that into crypto, the design constraints that we use for Mountain are very similar. The original product that we got inspired to is a bank, right? So it's a regulated product. That is super important because risk and capital preservation is the core item. We know from hundreds and hundreds of years of financial history that the only way you can really build safe financial products is by having a dual layer of defense. You have the company that is creating the product, but you have a regulator that doesn't have growth and bottom line as their incentive. Their incentive is that things don't explode, kind of double like checking the work and essentially approving everything. So for us, that was a core component of why would we build Mountain Protocol as a regulated entity first. The second is the product itself needs to be a stablecoin, right? Like it needs to be something that you can use on your day-to-day operations and be able to move it around and do whatever you want, right? So similar to high-yield checking account, there is no lockup periods. You don't need to be planning on how much you're going to spend to do a T-bill ladder, et cetera. And I would say the last one is the construction of the stablecoin itself needs to be non-innovative at all, right? We need to use the kind of like the industry standards of how we know how to build a stablecoin. So that how does USDM look like when taking from that inspiration? USDM is a one-to-one USD asset, right? So, and it's backed by US Treasuries and US Treasury equivalents, so like very, very low risk assets. Essentially, you're facing the US government with that collateral issues a USDM stablecoin. So it's one-to-one. That USDM stablecoin rebases itself, so you don't have to lend it, you don't have to stake it, you don't have to do anything. It accrues yield via rewards every day just by holding the asset, similar to a high yield checking account. And all of the structure is done under a BMA license, so that's a Bermuda Monetary Authority. In my opinion, the top crypto regulator right now. And they essentially license the company, but also review everything we do, every new change that we do to ensure that essentially they advocate for the USDM holder. And that's how USDM holders can be sure that their product is safe. And I would say to do a small leeway on Bermuda, for those that don't know Bermuda, it starts with a B and it's an island. So many people compare Bermuda with other islands. We've had experiences with islands that start with B and not great outcomes. I would say Bermuda's value prop is very different from some of those other islands. Those other islands, maybe their job to be done is hide money from the rich, right? That's the main activity. Bermuda, I would say, is very different from that. Is allow super big financial enterprises to run complex products with clear rules and clear legal system. So Bermuda's it's an offshore UK territory. The Supreme Court is actually in the UK, and they run a third of the global reinsurance business, which is very, very complex. Lots of litigation whenever you have downside. So, and they are an island that lives out of that. The last thing they want is to have something explode on their purview, because they live out of financial services. So to close, USDM, yield-bearing stablecoin. It's a $1 asset. You can move it to whatever you want, similar to what you would do with a USDC or a USDT, but it is yield-bearing. And in the back end, you have T-bills in terms of the collateral, but also the whole structuring of it is done under top prudential standards, which is, in my opinion, how all stablecoins are going to continue to evolve in the future if we look at what regulation is happening today. Sorry, that was a long-winded way, but I think I wanted to introduce Mountain as well.
No, of course. Like, and I think one cool thing about like Mountain, and this is a little bit my personal view on this, it's the fact that it's always one-to-one, right? So it's easy to understand. It's easy like to dispose and to use on a daily basis. Like, how do you see, like, in some sense, I know that the fact that the product rebases every day and you have like a rebalancing system, like we with some clients, like we try to explain them that this could be an alternative to tokenized securities in some sense, because like in the end the collateral, it's a security, which is US Treasury bills. How do you position USDM when comparing like yield-bearing stablecoins with the tokenized securities?
Yes. So, and that's a question that we get a lot. So, first of all, kind of to define the two legal frameworks, right? So, securities versus prudential regulation. Securities, you can have a U.S. Treasury bill might be a security. GameStop stock might also be a security, right? So, the fact that something is a security doesn't mean it's safe. A security will fall under one of two regimes. It will be either a registered security, or it will be an unregistered security under some exception. And most countries have something like a framework that looks that way. Usually, and most products out there in crypto are unregistered securities. And the unregistered security, like what the securities law looks to optimize is, let's make sure the disclosure is there so that the client knows exactly what they're buying. And let's make sure that the market cannot be steered or abused in some way. So the securities law is worried about disclosure and market abuse, right? The securities law should not be, and I say should not because sometimes they do, but should not be involved in what risk you're taking. Most products that we have today on crypto tend to be unregistered securities. And when you have an unregistered security, the regulator will tell you, okay, you can sell it, but because you have not done all the disclosure, you're only going to be able to sell it to people we believe can understand your product themselves and might ask the right questions. So those unregistered securities will be to accredited investors if you're in the US, might be professional investors if you're in the BVI. There's different names, but there's some bar that you have to cut. What that means is the tokenized securities are about disclosure, or might not be registered, and the disclosure you have to look at it yourself. But it depends on you to understand what's behind them. And the structuring might be good structuring, might not be good structuring, and the job of finding that out is on you as a buyer if you're an accredited investor. In prudential regulation, which is what we follow and what I think most of stablecoins will follow, what the regulators say is this is a systemically important asset, right? So your banking system, your insurance system, your payment system, these are things that should not fail. Like if you're like, let's say you buy an insurance for something and suddenly that insurance company goes under, and what you thought was insured is actually not insured. These are so products are so complex, and so systemic that the government gets in and says, we want to regulate these assets to make sure that we act on behalf of the consumer and make sure that these assets are safe. These products don't have an unregistered path. Everything has to be registered. But the advantage is because the government is like the regulator is verifying that this asset is safe, you as the buyer, if you trust this regulator, of course, can be more comfortable buying this asset. And that's kind of what yield-bearing stablecoins are or should be, is assets that the government is giving a stamp of approval saying USDM, for example, we believe is safe to talk. Let's do this 30-second break.
Give me just 1 second. I'll be in a minute. Sorry.
Yeah.
I'm back.
Awesome.
Sorry about this.
There we go. So we were talking about securities, which are about disclosure and market manipulation, and prudential products, which are about like the regulator actually stamping that this product is safe. So between the two, you have tokenized securities and prudentially regulated assets. There's from that regulatory structure stem a bunch of differences. The first one is, how sophisticated do you really want to be to buy this product, right? So if you're buying securities, you should do a diligence, assuming no one else did a diligence on buying that product, and you should expect something like an SEC filing or that level of detail to understand how the product is structured. In our case, that is the level of detail that we're giving our regulator for them to assess our product. On prudentially regulated products, you can rely a little bit more on the regulator to do that assessment. Of course, I do recommend do your own research. This is not a signal to not do any research, but you can trust there's a second. Yeah, exactly. You can trust there's a second person that is not incentivized on growth, putting their name. And I think that the important thing is the regulators, they rely on their reputation. No one wants to be the regulator that licenses a stablecoin that explodes. Right. So you are having someone that is stamping a product where all of their incentives should be to say no to any new products, because essentially they get hit once things go wrong and they don't get celebrated when things go well. So so that is kind of like the main difference. What does this mean to users? I think the first big implication is because securities have this, unregistered securities have these restrictions, which are most of the securities that you see on chain, they are not transferable. What that creates is a big delta between what crypto natives are used to dealing with, which are BTC, ETH, USDC, right? Like these are permissionless assets that you can move around. Permission securities have those limitations. B, you face issues with the subscription and redemption process, right? Like that process might be a lot more complex than when you're talking about a prudentially regulated asset, because the money needs to actually be off-ramp to purchase the asset, confirmed by the fund manager before you're issued a mint, because you only close a price when that happens. And same with the redemption. And the last issue is about safety that we talked about. On a yield-bearing stablecoins, on the other hand, you have a permissionless asset. You can use your multi-sig, right? Like we see a ton of users that hold USDM on their multi-sig and essentially add USDM into their existing treasury management operation, which makes it very, very simple for them. The second is on subscription and redemption, right? USDM, I think, Seb, we talk quite a bit about this, is very quick to mint and redeem, right? Like you can do it. We've had very big, even redemptions on Saturdays where folks swap back to USDC for a specific expense, and those happen very quickly. Which is very hard to do with securities. And the last one is around, of course, safety, right? Like having this second point of view. So I would say those are the three big differences. The permissionlessness, which is like the big thing that separates crypto from everything else, and then redemptions and safety.
So like I have actually a couple of more questions more than I had initially
Let's
in
do it.
our initial script. So like one thing that's and this is very important because this is a topic that not only you and me are always discussing. It's like things that our clients ask us all the time. Like when you are like your issuance and redemption, it's like phenomenal. It's like almost instantaneously, and once you confirm the transaction, we start like generating yield automatically. But how how do you guarantee first enough liquidity to do the issuance, and during the period of time, well, imagine I subscribe at a Saturday, and then you can only buy the underlying on Monday. How do you cover for for these 2 days of yield?
Yeah. So the first question around like issuance, speed of issuance and speed of redemptions. So speed of issuance is very simple, right? Like if you control the printing machine, we can print USDM. Of course, there's a process, but like quite quickly, right? And usually, depending on the size, most purchases you're not going to be needing to print USDM. There's enough USDM custody in the platform that you're taking USDM that's held in the Mantle Protocol platform, which is our website for primary users, where we are custodying USDM that people left in the platform. For redemptions, that's a very big question. So how do you redeem USDM quickly? And the answer is USDM is backed by T-bills. So the T-bills are only sold Monday through Friday business hours. And the settlement of those assets is usually T+1. So how do you, Seb, experience like T+0 or like instant, right? Like even a Saturday when the actual market is T+1 business? The way we do that is we have a network of market makers that are comfortable holding USDM during that period, and they are acting as the buffer between these two periods, and that gives us. They of course are compensated for that, and that's a fee that we pay them for that service. But that allows you to abstract away business hours. Like crypto doesn't know business hours, right? Crypto is 24/7. It allows you to abstract away all of that. And our job, when I told you we're mostly a TradFi business, is securing these repo arrangements, right? Like this is a transaction that in TradFi is very, very common, is structuring this same transaction with crypto players, right? So that is the main redeem. In terms of how we give you yield immediately, even before the asset is purchased. So right now, we're a venture-backed company, so that is subsidized by essentially how much the money we raised. The assets are not deployed on yield-bearing assets until Monday. Let's say you did this on a Saturday, until Monday, where these assets are purchased. There are players that are building native swap facilities for securities that we are entertaining, and that would allow us to essentially swap in. I think that you're moving the problem to someone else, because at the core, the TradFi system is not allowing you to buy that asset at that point in time. The core and the reason why we are still allowing purchases on Saturday and giving yield for Saturday and Sunday is we think that the system for buying securities should become more 24/7 as we evolve. So why not give that experience to the users today? And our job is to build that system more and more.
Yeah. Another topic that, or there are two important considerations, but I believe that one it's tax, another it's like an additional regulatory aspect regarding USDM. But regarding tax, I assume that Bermuda, as a position, for example, in Switzerland, if there is like something similar, like the yield that will be generated by the treasury bills will be subject to withholding tax. In your case, like, is this a consideration that USDM holders needs to have or not?
So first of all, this is not tax advice. Bermuda doesn't. Yeah, I'm not a tax expert. I'm not licensed to issue tax advice or anything like that. So in terms of representations, Bermuda doesn't. There's no tax implication to USDM in Bermuda. There's no withholding tax. So users will receive the full daily reward in their wallet. So there's no consideration of tax. We do have to do consideration of taxes for the USDM reserves. So that is part of what we do to ensure that we generate enough revenue there to fund the rewards. But as a user, there's no tax implications as of Bermuda, right, where we are issuing the stablecoin. However, each user needs to do their own tax diligence and understand what tax implications USDM might or might not generate. And I would say the closest proxy that you have to how USDM works is Lido's staked ETH, right? So staked ETH is also rebasing daily. Staked ETH also has the wrapped staked ETH, where we have wrapped USDM. So usually what we hear from most users is the application of the logic for wrapped staked ETH or for staked ETH is what they use for USDM, given that most countries don't have crypto-specific taxation, so they have to derive from parallels from TradFi into crypto, and they draw that parallel into what USDM, how USDM would be taxed locally wherever they're paying taxes.
Makes sense.
Yeah.
And then there is the big question, which is, what is the token classification for USDM? It's like a payment token. It's like a security token, a utility token. Like, what is the formal legal opinion on this?
Yeah, so Bermuda is very explicit about this. Bermuda was one of the first countries to pass digital asset regulation, and they understand stablecoins as payment tokens. They actually recently issued a new guidance, which is much more detailed on how stablecoins in Bermuda are to be issued. That's called, they call it single currency pegged stablecoins. SCPS is the guidance. And they see these tokens as payment tokens, which they leave a lot of flexibility on how you can build it. But essentially, they fall into one of two categories. You could be a narrow bank, which is kind of what we are, right? Fully backed by T-bills. Or you can be a Basel III bank, which is more like a tokenized the bank deposit, right? And they see those two as payment tokens. I have not yet seen one of the latter, but they leave the door open if someone were to come and build it. Having said that, there's 180 countries in the world, and each country will have their own definition of what a digital asset is. They might allow or not allow digital assets. They might have different definitions for what a stablecoin is. I personally think that stablecoins will go down the prudentially regulated path. I think as humanity, we have thrown the dice many times to see what the financial system will look like. And anything that's used for payments that is not a hard metal will usually fall into some kind of prudential regulation. And we've tried that in many countries across many restarts, reboots of the system, and we always fall into some kind of prudential regulation. And I think if you look at what the US is proposing, what Singapore is proposing, what Bermuda did, what the UK is proposing, they all look like prudentially regulated assets. Even what Mika is doing, UAE. So they are all going into that direction. I think with different nuances, right? So some ensuring a specific system, right? A narrow bank, or even a narrow bank that looks like an EMI, or some are more open, like Bermuda or Singapore, into it could be narrow banks, it could be tokenized bank deposits. I think the US is we never know. There's drafts yet. We don't know what's going to pass, but the US looks pretty strong, like they're going to allow tokenized bank deposits. And if that's the case, I think every country in the world will have to go into that direction, because you're not going to be able to compete with tokenized bank deposits.
Yeah, for sure. So I would say that the kind of classification that I was looking for, it was more from a US perspective. So I would assume that at this point in time, it's not available for US citizens, right?
It is not, right? I think the US for digital assets, they have expressed themselves on Bitcoin and recently on ETH with the approval of the ETH ETF. But most other digital assets, there's an open question on what they actually are, and Congress has not passed any regulation. With that uncertainty and with how expensive trials and lawyers are, we just don't participate in the US market. We don't see a path in which we can get USDM, or I think most companies in crypto follow the same strategies. There's no path. Might as well wait for clarity and then potentially get in. The way that is done for us is we take a very conservative view of saying, let's assume the prudential regulation that we have in Bermuda is not recognized by the US. And let's assume we don't fall under any kind of commodity or any other classification, and we take the other. And other in the US is a security. So let's assume worst case we are a security. In that case, how would you not have to essentially, like, how do you not participate in the US as a security? And the definition of that framework is called is Reg S. So it's Reg S exception, registration exception. And basically what Reg S does is there's a number of things that you need to comply. It's not just not selling to US persons. There's things around marketing, around how you structure your team, around how you structure your board of directors. There's a lot of implications around Reg S, which we take very seriously to make sure that we are never even close to the line of being subject to SEC oversight or any other US regulator oversight until clarity happens. Yeah, which hopefully happens soon. Who knows?
Yeah. So, like, we already talked quite a bit regarding like the regulatory standpoint, like the underlying infrastructure, the comparison between other products, but we didn't talk about like the most probably one of the most relevant topics, which is like, why should I hold USDM? Like, let's put it this way. Let's assume that I'm an organization, a crypto organization, that can have like a custodian account with like a big bank like UBS or Credit Suisse. No, Credit Suisse, it's UBS, so it's basically the same. But like with a custodian, like they can have like they can acquire directly the treasury bills or even the BlackRock ETF, like whatever it is. Why should, if they have access to this infrastructure, why should they use USDM?
Yeah, I'd say that there's several reasons, right? I'm gonna number them and then we can go in. But I think the first one has to do with the operational management of that, right? Like if you're a crypto company that is used to managing your like crypto native assets, USDM clearly fits into that, and we can talk about that a little bit more. I would say the second one is liquidity risk, and when you need the availability of those assets. And the last one has to do with counterparty risk. So let me start from the bottom because I think it's the closest one to the ones you talked. So if you're able to secure an account from, let's call it JP Morgan, to buy your treasuries, and JP Morgan will also, like, not just the custody, but also the bank account, and JP Morgan is comfortable opening that account for you, I'd say the counterparty risk that you're facing is very, very low, right? Like JP Morgan is a globally systemic important bank. So GSIB, it means that there's an implicit or more like almost explicit guarantee by the US government. So even if it fails, you're covered, right? Like they're going to save that bank. So the counterparty risk is low. In practice, most crypto companies don't face a JP Morgan, and more importantly, their bank is not JP Morgan as a bank. You are facing other banks that have a lot more credit risk or failure risk. So I think that the counterparty risk, like TradFi as a, like, I think in crypto we've seen hacks and stuff like that, and we feel crypto is very unsafe. I feel we forgot about 2023 and the bank failures, and we forgot about it because they got saved by the FDIC. But that the banks are not without risk, and even if you are safe, you might have a long time before you recover your assets if the FDIC doesn't decide to save you over that weekend. So I think that's number one. Who is your counterparty risk? With Mountain Protocol, you have the advantage that because we structure the flow of funds so quickly, you're essentially facing T-bill risk. mostly, and then on your flow of funds that would be slow on if you operate it yourself with Mountain Protocol, you almost don't face that risk. So that's the first one, which is your counterparties. And I'd say our full-time job is to manage your backend operation. If you do it yourself, you're probably not going to be managing and monitoring your vendors and monitoring the banks as much. Same way as if you hire AWS, it's their job to run your servers. Whereas if you're a company and you have servers, you're not going to be as optimized as them. The second one has to do with compliance risk, right? So crypto companies very famously know that on-ramping and off-ramping isn't as seamless as it maybe should be. And
With
kind of
Skyline
generally,
is.
Skyline is, yeah, you're familiar.
With
So
Skyline, it's easy to do all of that operations.
that's awesome. So there's liquidity risks to those types of assets, right? Like if you hold a T-bill, you have to sell it, you then have to send the money, you have to receive it in an account that you own, and then you have to send it somewhere else. That bank might ask you, oh, we see that the recipient is Skyline Digital, they're a crypto company, what are you trying to do? And depending on different countries' regulations, some countries have regulations where banks are responsible for fraud. So if banks see that money is going to crypto companies, they're going to block them, right? So and even if you don't have those types of rules, we know that crypto transactions are always more complex than other types of transactions would. So the liquidity risk is critical, not just compliance, but I would say liquidity in general, right? Like the speed that you can get out. So I would say that's the second. So we talked about counterparty risk. We talked about liquidity risk in general with a double click in compliance. And I would say the last one has to do with how you manage your assets, right? And if you're a crypto company, then you're used to self-custodying your assets in a safe. Most foundations and large crypto companies do it that way. Having an asset that seamlessly fits into that infrastructure, and it's just an ERC20, that's another line in the way you're managing your assets, whereby someone leaves your company, you change treasurers, you just change the signer in that multi-sig, and that's it. That is very seamless. On TradFi, if you have, let's say, you would have to have two custodians and two banks in order to be resilient. So there's 4 places in which you need to switch each signer. Each one of them have different requirements. Some are in the portal, some of them are a form, some of them require a call. Your management of those assets, maybe the assets are safe, but the management of those assets is not as safe. And very quickly, you might be in a position where you don't have access to your assets, or your assets can be moved by someone else. So management of assets is the last kind of very important topic. So counterparty risk, liquidity, and operational risk of the management of the assets.
Yeah, like this is actually something that I like. I didn't realize, or I didn't realize because probably I never thought enough about that. And it's interesting that you're mentioning that. Okay, if you have like a change in your finance team and whatever, and you still manage like to have like the setup with traditional banks, like the effort that will be like to change the person that will be accessing the products, it's like it's a nightmare. It will be like 1 month, 2 months with compliance of the banks to pass the individual KYC just to simply like to get to the access. And obviously, like if you use multi-sig, it's just like it's like this, and it's an interesting way for to keep control of the assets, which the self custody part that it's super important for us, while having like direct access to the products whenever it's needed. So yeah. So I would say that this is like an underappreciated risk
advantage
from
or
the
risk. Yeah. No one thinks about that risk until it happens, right? Like, we have to change it. We needed to make a payment, and now we have to wait for a month and a half to change the signers because we have a 2-sign rule and the other person left the company. Like, it happens when it happens. And the other thing is, even if you can do it as a business, it's maybe not your best allocation of time to be doing that, and those processes take a very long time. The last one that I didn't mention, because it's not risk, it's more like operational workload, is kind of like accounting and auditability, right? So having everything on chain makes those two processes a lot easier. Many businesses in crypto don't engage in that, and they essentially, because they're private companies, they don't have to. But it's a good practice, whether you're a foundation or whether you're a company that has to present accounting reports or even audit reports, to have everything in one place. It makes your accountant's life a lot easier. Cool.
And do you think, because like one of the things that you mentioned before, like, and this also relates like with this topic of the accounting, it's like, do you think it's easier to use the wrapped version or the native version of USDM?
Um, both work, I think, using depending on what you do. If you're going to be holding the asset for a very long period of time, and your accounting team is less versed with kind of crypto accounting and doesn't hasn't had experience with like tokens like staked ETH, a wrap token might be easier because that will behave like every other token they've seen. More advanced accounting teams will know how to manage kind of like rebasing assets because of lighter staked ETH. I believe we have two questions, one from Seva and one from Manu. I'm going to address Manu's first because it's very quick. So, will we release a governance token? The answer is, at some point, yes, I would like to. In practice, financial institutions, I feel, will be regulated financial institutions, I feel, will be the last type of entity to issue governance tokens, because the equity ownership and the UBO structure, UBO is the ultimate beneficiary owner of these structures, is very tightly controlled. The regulator wants to know who's making the decisions, who's appointing the CEO, who's appointing the board, and the ownership is very critical for that. So I think it's going to take a long time. I think we're going to see Coinbase tokenized stock before we see a Mountain Protocol token. The other question is from Sebastian Faria about the right mix of different assets, utility tokens, security tokens, stable coins, etc. And I would add to that the right mix of USD allocation, right? So, and here I think that this question from Seva alludes to how much should you hold, say, on your governance token, how much you should hold on USD assets like stablecoins, USDM, like maybe BIDO, and then how much you should hold kind of like on Bitcoin and ETH, right, or assets like that. I would say for your governance token and Bitcoin, ETH, and kind of like other blue chip crypto assets, I think that depends a lot on your business and what your view is and what your revenues and costs are indexed in. My perception is that most crypto companies are over-indexed on their governance token and on Bitcoin and ETH, right? Like they hold a lot of their treasury in those assets. And usually in bear markets, they regret it. They were like, we wish we had a little bit more of USD, because you're selling your governance token at the bottom, right? So you're selling at the bottom and not selling at the top. That's my perception. I'm not an asset manager or an expert in the space. I'm not going to opine on ratios, but in general, I see if you need to sell your governance token every month to pay for your expenses, you're probably too exposed to that token. You might want to have a USD denominated buffer, or even a BTC denominated buffer, so that even if your governance tokens go dips for a period of time, you're still able to execute the mission of your foundation, of your business, right? And weather that storm.
Yeah, that's actually a really interesting point, because like once you start looking at like projects in general, like they issue the token, and then like obviously they don't eat their own token, right? Like they need to sell it, like to make sure that they can do payrolling, they can execute like the mission of the mission of the project. And sometimes people stress out a lot when they see like some projects selling their token. It's not like serious project, they don't sell their token because like they are exiting the project. They sell it because like they need to pay bills. So maybe this is something that we should look at together, like, and see how can we put like support like these foundations not selling, but potentially like providing like a collateralized loan backed by USDM, for example.
Yeah. I would say the example that I like, it hasn't finished, but Arbitrum has a program called STEP, and they are engaging. It's a pilot program, so it's a small allocation um, of ARP tokens that would be swapped into USD assets, and they're running an RFP process and selecting vendors and so on. But I think that might change the overturn window on serious projects actually um, securing some more stable asset bags instead of a full governance token. So I think that might be happening more and more. And yeah, I think the structure in which they'll do it might be different across the board. The other question that we talked about. So how you build your portfolio in terms of governance token, Bitcoin, ETH, and dollars? I would say, if for the dollar portfolio, how do you build that one? That's another question that we receive a lot. And I think the answer there is, like, if you think about the efficient frontier, right? Like, you have T-bills are kind of like the lowest risk asset. Like, you're facing the US government, which always can issue more USD. So essentially, it's kind of as risk-free as you can in dollars. So kind of T-bill backed stablecoins, that would be USDM, it would be USDC, it would be BIDL. We kind of fall into that category of T-bill backed assets. Then you have your over collateralized lending, that is your Aave, your Compound. Those products obviously pay more, but you're facing more risk, right? Like, you're still facing smart contract risk, you're facing Oracle risk, you're facing bad debt risks. I think these protocols are pretty battle tested by now, but still the risk is not comparable to a T-bill in dollars, because even if you think about it from first principles, Aave has a ton of USDC. USDC is backed by T-bills. So Aave necessarily has to be as risky or more risky than T-bills, because that's one of the assets that they use, and they use multiple. And you're as safe as the kind of all of the big assets that you have there. And then you have kind of more asset management strategies like SDAI, which is a mix of a number of assets, and all the way to the basis trade. And what we
including
see,
real world assets already,
including
it's not like including real world assets nowadays. Like, they have like a big team managing like this part today.
yeah, I think there's a lot of controversy with those teams now in terms of reporting and risk and redundancy. I do expect to see changes in how Maker is allocating those real world assets. Shameless plug, like, would love to help them. I think we can help them in the PSM and also in the real world asset line. But the current teams, I think they're missing reports. They're working with a single counterparty with a complex flow of funds. So I think there's changes due on the Maker side. So yeah, I would say in that efficient frontier, where we see most like teams said is they just hold USDC, right? So they go T-bill, so they go to the minimum risk level, and they're holding that USDC because it's very familiar, it's very liquid, right? It solves all of the questions that we talked at the beginning, right? So it's easy to move, easy to pay. You can run it on your multi-sig, etc.
It's a standard nowadays.
It's a standard, yes. Some people will still run USDT. I would say those are mostly the people that we see running holding USDT tend to be less kind of crypto native teams and more emerging market businesses or high net worth individuals. USDT is still king on emerging markets, but I would say USDT.
And retail now.
And retail as well, but retail doesn't hold a ton of money, and they don't think like they use USDT as their savings account, but I wouldn't consider that treasury management. It just it's a simplified version of treasury management, if you will. So, and I think that we talked about one big mistake, which is keeping a ton of governance token and kind of not diversifying into other assets. I think the other mistake is staying in USDC and essentially paying the 5% USDC tax that you're not getting paid by Circle, right? So the underlying T-bills are making 5%, and Circle is keeping all that 5%, or Tether is keeping all that 5%. So you're taking the USD T-bill risk, but you're not getting the rate that is there. I would say inside of that, getting that rate, there's a number of products. I would say most of them are tokenized securities, which has their advantages and their disadvantages that we've discussed, or you have yield-bearing stable coins like USDM to be an alternative there. And that's where we want to play. I would say for most treasury managers, and where the objective is capital preservation, I don't know if I would go too far on the risk curve. It feels like if something happens, the objective of your protocol is not to make an additional 1 or 2%. Your objective of your protocol is more capital preservation. But I think that's a trade-off that each treasury manager with their team should make.
Awesome. Martin, we are really close to the end. So we have like 2 questions here from Manu and Martin. So maybe if you could like answer them, and then like I have like 1 or 2 last questions, and we adjourn.
Awesome. Yeah, and I do have to leave on time. So I'm going to address Manu's question, which is what happens with USDM on a 3-year bear market? And the second question is by Martin Sigwald. Would my USDM holding be directly affected by an interest rate policy change by the Fed? What is the overall duration of the T-bill holdings backing USDM? So I would say bear markets are actually better for something like USDM than bull markets. The reason for that is on bull markets, the alternatives that we talk about, this risk curve, the slope of that curve starts to grow significantly. So the delta of lending to someone that is levering up on Bitcoin is bigger than in bear markets. If we look at 2022 or 2023, lending rates were at about 2% or maybe sometimes even 1%, whereas the T-bills were paying 5%. So bear markets are actually better. The second question is what happens with interest rate policy. And here, USDM holds very short-term assets. So if rates go up or down, the portfolio circles so fast. So the maximum allowed maturity is 60 days. In practice, we have more like 30 days. So it's very, very quick to turn around the assets. The key thing is we make revenue by the interest of those assets, and then we pay interest expense on the rewards. So essentially, if our revenue goes down, we'll have to adjust the reward system to kind of match that. So we are very sensitive to market conditions, but in general, in any market condition, you're better off by getting some reward for your stablecoins than getting nothing on your stablecoins.
The worst scenario is if we get like negative interest rates. That would be like the worrying scenario.
That is the worrying scenario. I feel pretty confident that we're not going to go there anytime soon, but who knows? Anything can happen.
Yeah. So one last question. It's like we have so many products today. Like you know that this is the hottest topic. Like with Ondo Finance backed, like all of the others. Like how can we distinguish them? Like how can a treasurer or CFO like distinguish them and take like an informed decision?
Yeah, I would say today that job is very hard. Each project you talk to will tell you that their project is the best, and I think, of course, I'll tell you Mountain is the best. We built it with that in mind, but of course, I have a horse in the race. I think 2 objective things that are happening. One is the Arbitrum Step program. All of the applications happened in the light of day, so you can see the applications from 17 projects that got pre-filtered. And soon they'll issue their outcomes. They actually hired legal teams and so on to figure out what the outcomes should be. So I think that's a good one to watch. The other one is there's a study that is being commissioned to kind of compare all these options and give you an idea of what are the rationales to buy one from the other. But I would say the general questions are, how is this structure? Is it safe, right? Like, is it a structure that I understand or not? Is it vetted by someone else, right? Like, has a regulator actually vetted this structure, or am I my last barrier of defense? Who are the counterparties that I'm getting access to, and what is the real risk? I feel like one of the big things people index on are custodians and custody in the US. We've seen custodians fail, for example, in 2008. It's not a risk, right? Like the securities are not part of the bankruptcy estate. But then you have others that are important, right? Like banks. So understanding counterparties is important. Product features, right? Like how easy it is to mint and redeem, and fees involved. Many times this is how you get caught into a product that you cannot exit. So asking those are very important. And then just try it out, right? Like if you can give the product a spin and actually buy it on the secondary market and understand how the product works, that's a good way of testing the product. So yeah, I would say that's how I would look at it. Today, I understand it's a little bit hard because you have to talk to the issuers themselves. But these two resources, I'm excited that are coming out and will help treasury managers make their life a lot easier.
There are companies like Skyline that can interact directly with the issuers, which simplifies also the processes. Cool, Martin. I know that you are in a rush. I don't want to take more of your time. It was a pleasure, and I hope to do this soon again.
Awesome. Seb, thank you for having me. Take care.
Thank you. Bye-bye. Cheers.
Bye-bye.